Welcome to the Professional Edge. My name's Sean Todd, tax attorney, CPA, and certified financial planner. I appreciate you listening here. And this session, we are talking about investment portfolio concerns. We have the current situation over in Iran that has created some volatility. We've seen oil skyrocket to $118 a barrel, and then have the largest one-day slide on the decrease in the price of crude oil. And that, when you think about it, crude oil is in a lot of our products, anywhere from your trash bags to your trash cans to your rubber floor mats and things that may go in your shower. So the price of petroleum has a lasting effect on things. And yes, the uncertainty in the supply chain of that petroleum also adds to volatility in the market. So when we take a look at today's topic, investment portfolio concerns, well, with that, we got to look at the volatility. If you look back over the course in time, back in the 70s, we historically look at that. We say, how long does these conflicts last, number one? And number two, what is the most volatility that we can see in the marketplace? And, historically, it can be as low as 20% drop, and it may take as long as 6 years. That was in the 1970s on the oil embargo and situations there, that it took 6 years to get back to where it was prior to the conflict. So we hope that that is not going to be a concern, but just in case it is, let's talk about your investment portfolio concerns. We have volatility in the market, and given the past 3 years, a lot of our listeners here on the Professional Edge have been rewarded being that disciplined investor and not reacting to headlines and maintaining a properly diversified portfolio, meaning the winners, sometimes you got to sell some of those winners and diversify to reduce your risk in your portfolio. Now, the other big indicator is AI. That's disrupting the software companies, and everyone thinks that AI is going to replace software, or software is not going to be as important of a business product. And therefore, if that's the case, then the demand for that software is going to go down. And therefore, the price of those underlying companies that produce that software is going to go down as well. So we've seen that volatility within that space as well. And being an undisciplined investor, then you may have not been trimming and reallocating and rediversifying your portfolio, because 90% of your portfolio's returns is based on how you diversify within your portfolio. So you, as a listener here on the Professional Edge, you get to ask yourself, when was the last time you honestly sat down and had an evaluation of your portfolio on how it is diversified? Or have you let the winners continue to be winners and continue to be winners, and now they represent a very substantial portion of your portfolio? And if that's in the tech sector, well, here as of late, you've received that effect for the volatility. So again, that's a conversation to have. We have that first conversation complimentary. The number to call is 404-250-9798. That number again, 404-250-9798. So one of the risks that we have talked about here on the Professional Edge is this sequence of return risk. And what does that actually mean? Well, we all know that the market does not every year get a 10% rate of return or a 15% rate of return year after year after year after year. If you remember from 07 to 09, when we had the housing crisis, the markets went down by over 50%. Let me say that number again, 50%. So if you had $1 million portfolio and you retired in 2006, then you're like, hey, I have $1 million portfolio. Look at this. If I get my 10% return, I'm going to get $100,000. I'm in my golden era of retirement. Well, lo and behold, at the end of 2009, your sequence of return risk, you had 2 bad years the very first year of your retirement. you are down over 50%. So that $1 million portfolio that took you 30 years to build during your career is now within 2 years of you retiring at less than $500,000. That's with no withdrawals. That's just the market rate of return. So that's where we address the sequence of return risk, meaning if you retired in '06, you hit '07, '08, '09, you're down over 50%. So we take a look at that at estate management counselors and say, what is your probability of success given the sequence of return risk? Meaning if you started in '06, what is your probability outcome of having that successful, secure retirement versus you retired 3 years ago? Well, the market the past 3 years has been off the spectrum, meaning it has been way above average. So you think that you can now increase your spending because the market's done so well and it's going to repeat itself. Yes, that you're fooling yourself. So again, we run this through a computer program and it says, what is the probability of success given 1,000 random rates of return on your portfolio? What is the sustainability of having your portfolio be able to produce the returns that you need in order to run out of time before you run out of money? That's an analysis that it would take forever to do on a piece of paper, but the software that we use does it very quickly. And now, given 1,000 random rates of return in the market, because we know the market rate of return is random, then we know your probability of success. Could be 60%, could be 80%. And we say, okay, if we drop down your withdrawal rate by, let's say, $2,000 per month, what is the probability of success? Well, those are great numbers to know as a soon-to-be retiree saying, hey, if I can accumulate $1.5 million and I want to withdraw $5,000 a month, spendable, what is my probability of success? And address the sequence of return risk in your portfolio. So again, to run that analysis for you, be happy to sit down, have a chat. The number to call is 404-250-9798. That number again, 404-250-9798. So in our investment portfolio concerns, the other concern that we have to address is our longevity risk. We are the first generation that is retiring now that has to plan for being alive 20 years in retirement. Think about that. You are going to retire and your expectation is a 20-year commitment to having enough retirement income to sustain yourself. That's called longevity risk. It's a double-edged sword. The previous generation would only have to plan for about 7 years in retirement. Think about that for a second. A 7-year spend versus a 20-year spend. Completely different math. So the longevity risk, that's again another one of these how or what is the probability of your portfolio being able to sustain itself for a 20-year longevity on paying out? And as we all know, inflation has to be accounted for because the same dollars that you're spending today are not going to have the same purchasing power if inflation just stays at its normal historical rate of what it's going to be. So that loaf of bread that you're paying $5 for now is probably going to be $10 in that year 15, 16, 17 of your retirement. So is your portfolio going to A, sustain and grow enough so you have the same purchasing power of that $5,000 distribution in our example 15 years from now? Well, again, running it on the software, taking into account the inflation rate risk and then your longevity risk. Is your portfolio sustainable for this? And we put back into the context the sequence of return risk. Again, you start '07 as your first year of retirement. By '09, you've lost half of your portfolio value. The legendary investor Warren Buffett has 2 rules of investing. That's all he has. And he's a centi-billionaire. Okay. First rule is don't lose your capital. Rule number 2 is don't forget rule number 1. So what have you done inside your investment portfolio to actually protect your principal, protect your investment? So we have that volatility in the market. We have the sequence of return risk, and we've addressed longevity risk. So why is the principal protection so important? Let's think about this. If the market goes down by 50%, okay, so now 50%, where are you at now? Well, on our example, we have $1 million that go down by 50%. You're now at $500,000. But what if the market returns 50% back? Are you back to your $1 million? The answer is no, because you would have to have 100% return to make up that 50% return. So let's go through the math real quick. 50% drop, $1 million goes to $500,000. But a 50% increase is now based on $500,000, and therefore it's only $250,000. So even though the market recovers by 50%, the same amount it dropped, it is still down by 25%. So again, the preservation of your principal is very important. So again, you got to ask yourself, what have you placed in your portfolio to protect this principal? Now, am I saying you need to protect all your principal? The answer is no. But you got to have some strategies to protect that principal, because that is the energy or the engine of your portfolio performance to generate a rate of return. So again, to have that candid conversation, give our office a call at 404-250-9798. That number again, 404-250-9798. My name's Sean Todd, host here on the Professional Edge, tax attorney, CPA, certified financial planner. More coming up on the Professional Edge.
With today's financial markets, are you getting the personal and professional attention you and your money deserve? Clients of estate management counselors benefit from having one set of professionals advise them on their tax, estate planning, and investment advice. We call that the Professional Edge. Sean Todd is a tax attorney, CPA, and certified financial planner. With over 15 years' experience, he welcomes the opportunity to assist you in preparing for retirement, implement effective tax planning strategies, and to help you properly plan your estate. His radio show, The Professional Edge, is aired weekly on Sundays at 9 a.m. If you're interested in meeting with Sean, call his office at 877-654-9798. That's 877-654-9798. Do you want to feel more confident about making the right investment, tax, and estate planning decisions? Today, these decisions are more complex than ever. Have you thought about working with a professional advisor and not sure who to turn to? Not sure what qualifies one to be an advisor? Sean Todd is more than qualified as a tax attorney, CPA, and certified financial planner. Sean is with Estate Management Counselors. Estate Management Counselors operates as an independent fee-only investment advisory firm. They're dedicated to gaining a personal understanding of their clients' objectives and implementing professional counsel and advice to achieve those objectives. So take a second to talk with Sean Todd to learn how you can benefit from their multidisciplinary practice, where they coordinate their clients' legal, tax, and investment strategies into one comprehensive and integrated plan to enhance and protect their clients' financial security. You can reach Estate Management Counselors and speak with Sean Todd by calling 1-877-654-9798. That's 1-877-654-9798.